A quiet but powerful shift just hit the U.S. financial system. And it's not coming from Wall Street. It's coming from Washington. The Consumer Financial Protection Bureau, CFPB, has officially announced new rules that bring big tech wallet platforms like Apple Pay, Google Pay, Venmo, and Cash App under the same federal supervision as banks. That means these companies, once treated as tech firms, will now face the same oversight, audits, and compliance standards as financial institutions. And this changes everything. Because for years, big tech has operated in a gray zone, sitting between technology and finance. They handled billions of dollars in payments, stored user balances, and processed transactions. But they weren't regulated like banks. That era is over. The question now is, why did regulators act? What does this mean for the future of digital wallets? And how will it reshape how Americans move their money? Let's break it down. First, what exactly happened? The Consumer Financial Protection Bureau finalized a landmark rule that classifies major digital payment platforms as larger participants in the payments industry. In plain English, if you're a tech company handling over 5 million transactions a year, you're now under federal supervision. That includes Apple Pay, Google Pay, PayPal, Venmo, Cash App, MetaPay. These companies will now be subject to the same kind of monitoring as banks, including compliance checks for consumer protection, fraud prevention, and fair lending laws. This means Washington officially recognizes big tech as part of the U.S. financial system. So why now? Why this crackdown in 2025? 3 reasons: scale, risk, and influence. First, scale. Digital wallets have exploded in usage. Over 75% of American adults now use at least one wallet app for payments, transfers, or online shopping. Collectively, these platforms move trillions of dollars annually. That's not a side business anymore. That's the backbone of retail finance. Second, risk. As wallets grow, so do the risks. Hacks, scams, data leaks, and unauthorized transfers have risen sharply. Users often have little legal protection when something goes wrong, because wallet providers aren't traditional banks. And third, influence. Big tech's growing control over payments gives them immense power. Not just over transactions, but over data. Every payment, location, and purchase becomes a data point in a massive behavioral database. Regulators worry this concentration of financial data in the hands of tech giants could threaten privacy and competition. In short, wallets became too big, too fast, and now Washington wants a seat at the table. Here's what changes under the new rules. From now on, digital wallet companies must submit to regular CFPB examinations, the same kind banks face, implement stronger consumer protection measures, disclose fees, limits, and transaction terms clearly, maintain anti-fraud and anti-money laundering programs, protect customer funds from misuse or mismanagement. This means the freewheeling world of wallet startups is about to become a lot more like traditional banking, and that's going to reshape how these companies operate and how consumers experience them. Let's talk about the winners and losers. On one hand, consumers win. You'll get better transparency, more accountability, and more protection. If your Venmo balance disappears or your Cash App transaction fails, regulators will now have the power to intervene, something that didn't exist before. On the other hand, tech companies lose flexibility. They'll face compliance costs, slower product rollouts, and restrictions on how they can use data. For companies like Apple and Google, which thrive on data ecosystems, that's a big deal. They'll need to separate payment data from advertising data, limit cross-use, and prove they're not exploiting their platforms for unfair advantage. In other words, they're being forced to choose between being tech companies or financial institutions. They can't be both anymore. This move also has major implications for banks. For years, banks watched as big tech slowly ate into their payments business, taking over mobile transfers, peer-to-peer payments, and even small business transactions. Now, banks see an opportunity. If tech companies have to follow the same rules, the competitive advantage they enjoyed, less regulation, faster innovation, starts to shrink. In fact, some banks are preparing to launch their own strategic wallets, digital platforms built with compliance baked in from day one. The idea is to compete directly with tech wallets, but with the added trust and protection of bank regulation. That could create a new generation of bank tech hybrids, financial ecosystems that combine the innovation of Silicon Valley with the security of Wall Street. But there's a bigger story here, one about control. Digital wallets aren't just payment tools anymore. They're becoming gateways to the economy. Apple Pay sits on top of iPhones. Google Pay is tied to Android. If these platforms decide which payment systems or currencies can be used, they gain enormous power over economic access. That's why the US government is stepping in now, before that power becomes monopolized. Regulators want to ensure that no single company can control who gets to send, receive, or store money in the digital age. In that sense, this isn't just financial regulation. It's economic governance for the digital era. There's also a global angle. The US is watching closely as the European Union rolls out its own Digital Markets Act, which forces big tech firms to open their wallet systems to competitors. The US isn't going quite that far yet, but the CFPB's move could be the first step toward a broader regulatory model that defines how digital payment ecosystems are built worldwide. If successful, it could become the template for global wallet oversight, one that balances innovation with accountability. So what does this mean for the future? In the short term, expect tighter compliance and more transparency from wallet providers. You might start seeing clearer terms of service, stronger verification processes, and better customer protection systems. In the long term, this could lead to interoperability, the ability to move funds seamlessly between different wallet systems, just like you can transfer money between banks today. It could also pave the way for federal digital currency integration. If the US ever launches a digital dollar or central bank wallet, these same rules will form the foundation for how it operates. The big picture. For over a decade, big tech wallets operated in the gray, financial enough to make billions, but tech enough to avoid the rules. Now, Washington has caught up. The CFPB's new rule is more than regulation. It's a reality check. It tells Apple, Google, PayPal, and every fintech giant, if you move money, you're part of the financial system. And the rules apply to you. It's the start of a new era. One where the wallet in your pocket is as regulated as the bank in your neighborhood. And that could reshape not just how we pay, but who truly controls the future of money.